Thank you, April, and welcome everybody. Before we get into the crux of this year's survey results, I'd like to take the opportunity to provide you with a brief background into Hays and our co-contributors, Oil and Gas Job Search. Hays are a leading global staffing and recruiting company. We work across a multitude of industries, including oil and gas, attracting the best talent and matching them to the best jobs in the market, both on a contract and a full-time basis. In the main, we focus on white-collar professionals within engineering, IT, accounting and finance, human resources, and project functional areas. In addition, we're also a managed service provider. Employers outsource their recruitment processes and their temp and contractor management to us, and we provide technology platforms that make these processes more efficient and effective. We have approximately 9,000 staff across 33 countries, and last year we placed 63,000 people into permanent roles and over 200,000 into new temporary or contract assignments. The survey is jointly created with our partners Oil and Gas Job Search, one of the industry's leading job sites. Their database, containing over 1 million industry professionals, is a great source of candidates. I can highly recommend you visit their website. So quick background into the survey. So 7 years ago, we started publishing our salary survey guide for the oil and gas industry because we found that there was not a source of compensation information available that was at the same time both broad, as in global, and detailed, as in the functional disciplines, and provided information on the context of local hiring and labour markets. Our aim is to provide our clients and job seekers with the information regarding the trends in compensation and benefits, particularly as this varies from country to country. Given the global nature of our business and the fact that almost a third of workers work outside of their country of origin, we believe that our salary guide is a useful resource both for companies and job seekers alike. This year we had over 28,000 respondents who represent a strong cross-section of our industry, from super majors and IOCs to smaller operators, from service companies to EPCs and equipment manufacturers, from over 178 countries. 28 disciplines were covered, including reservoir engineers, geosciences, petroleum, construction, project controls, package engineers, and so forth, at varying levels of experience, from entry-level graduates through to senior vice presidents. So I thought it'd be worth just taking a very quick recap of 2015 and some of the things that have affected our industry. Whilst I'm sure that we all don't need reminding what a tough year 2015 was for the oil and gas industry, especially those in the upstream and service sectors, the slide provides some context and meaning to this year's results. The anticipated V-shaped recovery predicted by many analysts never materialised, as the Saudis continued to pump at record levels in order to control market share. The price per barrel continued to slide, causing many E&Ps to dig out their 1980s crash playbooks of cutting expenditure, deferring capital projects, cutting ops expenditure and reducing headcount, whilst pushing suppliers for better pricing and, let's be honest, praying for better prices. The resulting actions have seen approximately $300 billion in capex cuts and nearly $1.5 trillion worth of projects either cancelled or delayed. So let's take a look at this year's survey and see what effect these actions have had on the results. So what are employers concerned about? No surprises in the global figures that 56% said over the next 3 months their #1 concern is economic instability. However, globally, towards the fourth quarter, this figure drops to 34%, an optimistic sign of more positive things to come later in the year. At that point, employers expect skill shortages to be the growing concern, and we'll take an in-depth look regarding the skill shortages and knowledge loss concerns later in the presentation. So what do Canadian employers have to say? Again, not overly surprising, but probably a true reflection of the oil sands in Alberta right now. 77% of employers cited economic instability as their #1 concern in the first 6 months of 2016, and 46% have growing concerns over the skill shortages moving forward. So how have employers been affected? Well, 32% of employers globally have endured some form of headcount changes. 29% of employers globally have had changes in their workloads, and 32% of respondents worldwide have been laid off or made redundant due to the current downturn. And how does this compare in Canada? 31% of respondents have taken some form of cost reductions by way of headcount reductions. And 57% of employee respondents indicated that they had been laid off due to the downturn. Canada appears to have been affected far more than the global averages, possibly due to the high costs of production. So looking forward, what are employers' expectations for the market over the next 12 months? Initially, the outlook is somewhat subdued, with less than a quarter of those surveyed expecting any signs of recovery. However, as you follow the dark blue line on the graph above, you'll see as we enter the back half of the year, over 50% of respondents anticipate a strengthening in the market. And in Canada, well, only 45% of respondents have confidence in the market short term, considerably lower than the global average of 63%. However, as we enter the fourth quarter of 2016, the figure for Canadian employers indicating their belief that the market will strengthen raises to 58%, slightly above the global average. It's not all glum news for the employment market, as over a third of our employers still intend to hire throughout 2016, although these are likely to be business critical positions rather than through expansion. In Canada, the figure is slightly lower at 30%, with cost control engineers, corrosion engineers and electrical engineers continuing to be in demand. Now we're going to take a look at the salary data, probably the bit that a lot of you are interested in, and see what this year's surveys tells us. Overall, salaries decreased by 1.4% globally on a like-for-like basis, with the overall permanent salary globally for the oil and gas industry at $82,000, local permanent salaries at $68,000, and expat permanent salaries at $98,000. The average day rate contractor came in at just over $500 a day. And in Canada, what I would say here is please bear in mind that since the data was collected for the survey, the US dollar has strengthened, particularly against the Canadian dollar. However, you can see here that the average salary in Canada came in at just shy of $112,000, with the average local salary just over $107,000, and expats coming in at about $126,000. So, what did our survey tell us about benefits this year? Well, training and development was the only one to see any kind of real uplift. And my initial reaction was that this was possibly a lag from pre-booked or prepaid training from the last quarter of 2014 or early 2015. However, it could also be a response to the workload changes, as indicated later in the presentation, as employers seek to upskill and create a workforce with multi-specialism skills in order to keep headcount numbers lower. An alternative theory provided is that it could also have been used as a motivator for those staff in the workforce that have seen large-scale redundancies, i.e., we know that you've seen a lot of change, however, we're still committed to those staff and want to ensure that you're equipped with the necessary skills to see us through these challenging times. An interesting concept, I'm sure you'll agree. In Canada, the most prevalent benefits this year were health plans, bonuses, retirement plans, training and paid overtime. 71% of employee respondents received benefits and nearly 3% percentage point increase year on year, indicating that Canadian employers, despite the downturn, still recognise the importance of staff welfare. This year, one of the key questions we asked of those laid off or made redundant was whether they were considering any possibility of roles outside of our industry. Something that should be of concern is that 71% of those respondents who are currently out of work said they were considering a role outside of oil and gas. If successful, this exodus of talent could cause considerable damage to the existing and future workforces. And for those interested, the three main industries that those seeking a role outside of our industry were renewable energies, construction and mining. However, confidence is still high, with 85% globally thinking that they'll be able to secure a new role within oil and gas. And in Canada, that figure was slightly lower at 75%, but still encouraging. Let's take a quick look at workforce planning. Every year, we like to look at how people in the oil and gas industry evaluate a job, whether it's their current position or a new role. It's not really surprising that every year to date, we've seen that compensation is the #1 consideration. But this changed for the first time this year, with company reputation climbing to #1. Is this significant? Well, I think so. I'll explain why a bit more over the next couple of slides. Compensation hasn't dropped too far. It comes in at #2, with career progression and benefits coming in 3rd and 4th. Those were the global results. So what did we find out about Canada? Well, as you can see here, Canadian oil and gas professionals agree that company reputation is the most important, with 42% saying that. Next, you'll see what I describe as a real change in attitude, and probably the main reason that compensation has dropped from #1 to #2, with 63% saying that they would be willing to take a pay cut to retain their current job. And encouragingly, 15% of companies have improved their succession planning processes, and 3% more companies offer benefits compared with last year. An observation here would be that if employers can get factors 1 and 3 right in particular, then compensation potentially represents a significant opportunity in cost savings to them over the short to medium term, without impacting retention or attraction in a significant way. As we saw earlier, a high percentage of our candidate respondents have been laid off, and we wanted to understand what sort of support those people may have been offered and consider how it might impact company reputation. This chart shows the type of assistance that employers have offered employees when making redundancies. It includes things like support from third parties, career counselling, referrals to other employers, financial support, and time off to attend interviews. Standing out like a sore thumb at the bottom there is the rather surprising fact that 60% received no support, which was extremely high and is probably skewed to some degree by the large number of contractors that have been laid off in the last year. Irrespective, when the market turns and companies look to ramp up their headcount, their reputation is going to have a big impact on their ability to do so. And employers are missing out on some really low-cost, high-value strategies that could have a big impact on this. I think it's also important to consider that as employers' reputation is as, if not more important, to existing employees as it is to future employees. So how colleagues get treated through these times could have a profound impact on retention. Now, these are the global figures. So how does Canada compare? Well, unfortunately, 64% of Canadian respondents that have been laid off due to the current downturn said that they've received no assistance, which is higher than the global average. So this is definitely something to think about. Next, let's shift our focus and take a brief look at succession planning. It'd be reasonable to say that this would be another low priority topic, particularly for companies at the moment. But we just saw that career progression is the 3rd most important factor when people are evaluating jobs. So it's interesting to see that 2/3 of our respondents said that they are either unsure if there is or know that there isn't a succession plan in place at their current company. And I'd argue that if an employee is unsure if one exists, in the same as there not actually being one. On top of that, 35% of respondents said that retention issues are caused or compounded by poor succession planning. So people are lost. They aren't aware of the opportunities available to them, and management teams aren't aware of the talent that's available to them within an organisation. So this is a real problem. Then we looked at how well companies use succession plans as a candidate attraction tool. And you can see here that only 5% explicitly use it as a strategy, whilst another 13% use training and development. I think it's fair to say that companies that actually have succession plans are missing out on an opportunity to leverage them from a recruitment perspective. For so many years, we see putting succession plan as an absolute necessity for all organisations. It's really not an expensive thing to do, but it can have a huge impact. And of course, there's no point in having one if you're not going to effectively communicate it to your existing staff. And lastly, why is this important? Why is it important to make this a priority? Because 75% of the employed survey respondents said that they were open to a new job for the right role. That's 75% of our existing workforce. Okay, so let's take a look at some of the employment and industry trends from the last year. Let's go to age demographics first, a topic that has received a lot of attention over the last few years. This graph shows the age spread of the global oil and gas workforce in dark blue versus that of Canada in light blue. Globally, there's a pretty healthy distribution skewed towards the younger generations. But in Canada, 48% of respondents are baby boomers and heading towards retirement. In fact, 64% are over 45. Theoretically, that means that 65% of the workforce will have retired within the next 20 years. By contrast, only 14% of our respondents were Generation Y, or under the age of 34. As I said, this is a well-documented topic, but you have to wonder how much a couple of years of reduced hiring at the junior level, whilst baby boomers continue to retire, can intensify the skill shortages facing the Canadian industry in the long term, and whether companies can afford not to continue hiring new talent through this downturn. Moving on to take a look at contractor and contractor use. A quick look at contractors. So typically, fewer Canadian companies engage contractors than the global average, this year being no different. The industry as a whole saw an increase of about 1% year on year, and you can see that 63% of employers expect contractor levels to hold steady throughout 2016. It wouldn't be surprising that, if we do see any sort of rally in the industry towards the end of the year, that contractor usage will increase ahead of permanent hiring, as companies will still be nervous to commit to permanent headcount. Looking at the imported workforce, you can see that Canada engages significantly fewer expats than the global average. In fact, North America as a whole does, mainly due to the challenges around immigration and the fact that traditionally there has been a relative lack of in-demand skills based overseas for Canadian companies to import. This year, Canada saw the second biggest decrease in the employment of expats, with a 22% decrease, although we could see an increase in the coming 12 to 24 months if some of the proposed LNG projects get some full momentum and they seek to import those with LNG expertise. I'd also say that given the age demographics catastrophe that's looming, should companies be looking to import more talent at the junior end to alleviate that pain? And lastly, a brief look at where the most desirable international destinations are for expats. Globally, the Middle East is the most attractive at the moment. Presumably, that's really the only busy market in the industry as we speak today. But Canadians are most likely to move to North America, and by that we mean the US. And likewise, Americans would much rather move north of the border to Canada. At the moment, 85% of the Canadian workforce would consider a role overseas, and more than half of them are ready to do that in the next 12 months. And unsurprisingly, virtually everyone said the reason they would consider a move overseas is for the money. Okay, so to finish off, we're just going to go over a few of the key findings and some of our recommendations before we open things up for some questioning. So, economic instability is the #1 employer concern for the first time in more than 6 years. Employers are hopeful to see signs of strengthening in the fourth quarter. Skill shortages are going to come back on the agenda. Canadians are currently prepared to take a pay cut to retain their job. Health plans are the most received benefit. Company reputation is now the #1 priority for people in their current or potential role. Worryingly for employers, a staggering 75% of the employed workforce are still looking for new jobs. So here's a couple of our key recommendations. I think the first one really is to look after your reputation as an employer and offer a decent level of support to workers and leavers. If you don't have a succession plan in place, now is the time to do so. And remember, there's no point in having it if you aren't communicating it, at least to your staff internally. Offer training to support skills gaps and boost staff morale. And if you feel you have a strong reputation supported by a robust succession plan, could you use compensation reduction as a strategy to help control costs throughout 2016? I'd like to thank you for taking your time. I hope you found it informative and will be able to use some of the information that's been in the presentation and obviously the salary guides with greater detail in your roles. There's a couple of questions that we always get asked around this kind of time, and the first one is, people often ask, how can I get hold of a copy of the guide? And our response is that one of our consultants will be in touch with you shortly to arrange receipt of the guide. And the second part is usually, will this presentation be available online? And yes, the answer is it will be later today. If you visit www.hayes-oilgas.com, you'll be able to find a copy of this presentation. So we'll open it up for questions and see whether or not we've got any. And it looks to me like we have a couple coming through here. So one of the questions that's been asked is, you mentioned about low-cost, high-value things employers can do to help those being made redundant. Can you give us some examples? Yeah, of course. I can actually give you a live example. One of my good friends actually got made redundant as part of the downturn, and he got his first job after graduating, and has been with the same company for the last 21 years. So he's never been on an interview. So some of the advice that we gave him was around kind of interview practice. You need to bear in mind, some people possibly haven't been on interview for years, potentially. The second piece of advice that I gave him, and something that Hayes have been very strong in developing, is building online profiles. You have to think, today, and particularly in today's market, the first place that potential employers are likely to look is going to be somewhere like LinkedIn. So it's making sure that your LinkedIn profile is up to date, and potentially providing support to them in showing them how LinkedIn works and making sure that their profile reads well. Resume advice, again, if you've been in the same employer for a period of time, it could have been a long while since you last wrote a resume. And I would also say making introductions to recruitment firms. It doesn't cost anything, and we can particularly offer advice around things like resume presentation and resume writing. And again, there's plenty of advice that you can find on the hayes-oilandgas.com website, particularly around preparing a good resume and social media profiles. Just bear with me to see if there are any other questions coming through. Okay. We started a succession plan, but it went off the boil. How do you keep a plan going? Okay, interesting. I can only really answer that as far as what I do and how Hayes uses succession plans. Every quarter we have obviously a review with my boss, and succession planning is always on that agenda. What have I done to identify the future leaders within our business, whether that's to take over my position or whether it's somebody else that's been identified as a future leader. I think the most important thing is to have senior leadership buy-in and understanding what it is that you're trying to achieve, and then ensuring every review meeting in little huddle groups, it's always on the agenda. It's always something that's being talked about, and it's always something that is being brought to the forefront. It doesn't need to be, you know, the most sophisticated of plans, but it needs to be addressed, and it needs to be on, like I say, on the agenda every time, you know, an HR kind of discussion or group huddles, you know, kind of involved. That would be my advice. And again, you know, it's the kind of thing that there are consultancies out there that can help put proper constructive plans in place. Just going to check, but it doesn't look like we have any other questions. So I'd like to just thank you all once again. Sorry, April.
I was just going to jump in and say I think that's all we've got time for, actually. So thank you so much, Neil, and thank you everyone who's dialed in. As Neil just mentioned there, the recording of this webinar, it'll be available later today at hayes-oilgas.com. Also, you will be contacted shortly with details on how you can get your hands on a copy of the guide. So thanks for taking part, thanks to Neil, and I hope you find the guide interesting and useful as part of your roles.